In this video, we're going to talk about the simple IRA for the sole proprietor. Now, if you don't know what a sole proprietor is, or if you qualify, then we're going to talk about that too. And then we're going to talk about the benefits of the simple IRA, why you might want to consider one for your saving strategies, and how to do the calculation, because there's a ton of confusion on the calculation for the simple IRA as a sole proprietor, because it is different. So we're going to clarify that for you. But before we do all this, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. So according to the IRS, a sole proprietor is someone who owns an unincorporated business by him or herself. And the reason this is important to make that distinction and to figure out whether or not you're a sole proprietor or not is because the calculations are different for the simple IRA. So we just want to make sure that you're the correct filer for this video as you're trying to figure out how to do this calculation. So now that we have that out of the way, the simple IRA is a great plan because you can put up to $13,000 for 2019 and $13,500 for 2020. And that's up to 100% of your employee side compensation. Now, as a sole proprietor, that is going to be your net profit. So you can put up to 100% into it, which is a lot different than something like a SEP IRA. While the SEP IRA has really high limits on what you can put in as far as total dollars, it's based on a percentage. Where the simple IRA, the employee side, you can put up to 100% of your compensation into the plan. And it also has a matching contribution. And this is where the calculation gets really confusing. But the contribution for the matching portion is up to 3%. So it's 1 to 3% on the employer side. And in addition, you can either do that or a 2%, what we call a non-elective contribution. Now that just means you're going to put in 2% no matter what happens throughout the course of the year. So 2% of your compensation. Now again, that compensation is a huge question mark on where to find that. So I'm going to show you exactly how to calculate it and the matching contribution. So I'm going to say that again. So there's employer and employee contributions to a simple IRA. So on the employee side, and remember, as a sole proprietor, you're wearing both hats. So you're both the employee and the employer. And that's really true of any business type. If you're an S Corp owner, you're still wearing both hats. If you're an LLC owner, you're still wearing both hats. But as far as a sole proprietor goes, it gets a little confusing when it comes to the simple IRA. So one more time. $13,000 for 2019, $13,500 for 2020. Then we flip over to the employer side. So that's a 1 to 3% match on the employer side. And that is in addition to the $13,000 or the $13,500. So you're putting in the $13,000 or up to the $13,000, and then your matching contributions are in addition to that. And that's 1 to 3% or the 2% non-elective. What that really means is if you don't put any money and you had a non-elective contribution, that means you have to still put in 2% of the total compensation, where the match depends on if you're gonna put the money in. So if you're putting in 3% as the employee, then you need to match yourself. I know that sounds kind of ridiculous because you're the same person wearing two hats, but that is the general rules on how the simple IRA works. So we're going to talk about the sole proprietor and how that calculation is figured out. But before we do that, I want to show you where to find this information, because if you check the internet, it's all over the place as to what the correct calculation is. And I want to make sure that you're doing this correctly. So I'm going to show you the sources and I'm going to show you where to find this information so you can make sure that you're doing it correctly. So the place that you would look to find all the information on the simple IRA is called Publication 560, which has all the rules for the simple IRA. So let's go ahead and jump into Publication 560. And chapter 3 is the one that's going to outline the simple IRAs. Now, if you thought it was as simple as just going here and figuring out the formula, it is a little bit more complicated than that, but I'm going to point it out and I'm going to walk you through it. And it gets a little technical, but what we really want to focus on is we want to know how much we can put into the simple IRA as a sole proprietor. Because again, we're going to put in our contributions as the employee, and then we're going to need to figure out what that matching contribution is. So what we're really trying to figure out is what is our compensation that we can base this on, and what is the matching rate that we can actually use. So at first glance, it seems pretty straightforward. If you are self-employed, compensation is your net earnings from self-employment, and here's where you can find it. Line 4 of short schedule SE. So a quick example, if I pull up your tax form and you look at your schedule SE or your self-employment tax, you could see line 4 is taking what your net profit is and multiplying it by 92.35%. And in this example, it's $100,000 multiplied by 92.35% gives us a planned compensation of $92,350. Now here's where some of the confusion might start. Is the $13,000 before or after you do this calculation? It's actually before, because if we go back to publication 560, it says compensation also includes the employee salary reduction contributions. So what this means is your compensation includes it. Just like a 401k, if you had a 401k or a 403b or other retirement plan, you're gonna take your gross amount and that's what it's all based on. So it's really the same math in this instance. Just that planned compensation includes the $92,350. All they're subtracting is your self-employment taxes. So that's what they're taking out. So if you really want to know what it is, Social Security is at 6.2% of your pay and Medicare is at 1.45%. Add those up, you're going to get 7.65%. 100 minus 7.65% is the exact same number that we just multiplied, which is 92.35%. Now, so far you might think this is pretty straightforward. All I need to go to is my tax document to find what that number is to figure out what my contribution limits are, right? The reason this is confusing is because net earnings in every other calculation, when it refers to 401ks or solo 401ks or SEP IRAs, is your net profit minus 1/2 of your self-employment, which gives you a different result. And you can find that 1/2 of self-employment right on that same schedule SE. And if we look to the bottom, it was $7,065. Well, it's slightly different if you subtract 100,000 minus 1/2 of self-employment, where it's $7,065 versus multiplying it by 1/2 of the rate. And the reason for that confusion is because the deductible portion is the second half of self-employment. And I know that's super confusing, but that's how the math is done. The other part of the confusion is the fact that you're using this multiplier, even though Social Security doesn't get taxed after $132,900 for 2019, and that's going to go up to $137,700 for 2020. So let's flip over to the next page of the publication 560 to look at an example of the Simple IRA contributions. And it says in 2018, your employee John Rose earned $25,000 and chose to defer 5% of his salary. Your net earnings from self-employment are $40,000. So it's not even doing a multiplier to figure out what our net profit is multiplied by the 92.35%. It's just going straight ahead and saying, this is your net earnings and this is the number that we're going to use. So we don't quite know what math they're actually doing there. So the example is a little cloudy. And if we jump to that second calculation, because the first one is as an employee, and then we jump to the second one as the employer, and it says the total contribution you make for yourself is $5,200. Here's how the math works. You're going to take that net profit of $40,000 and whatever contribution rate for yourself that you're applying. Now you can put any contribution rate that you want up to 100% of the $13,000 or that $13,500. So that doesn't matter. As long as it's over 3%, you know that you're going to max out that matching contribution. So the second part of that is the employer matching contribution is your net earnings or your compensation. They're all the same thing in this calculation, is 40,000 times 3%. Now, because you put in 10%, which is over 3%, you're going to give yourself 3%. If you had done 2%, then it would only be a 2% match. That's how you get to the 3%. But the confusion doesn't stop just there. Now, the reason I find this calculation in this example very misleading and kind of confusing is because you could still be an S Corp and be self-employed. So it doesn't really say that it's a sole proprietor. I really wish that they would go ahead and take that extra step and say that exactly so there is no confusion. Why is this all confusing when you just look at this section and say, well, if this is the formula that we're going to use, why not just apply it? It's because there's a worksheet at the back of the publication 560 that puts everything in question of how you should do this math. So let's jump to the worksheet at the very back of the publication 560. Now, chapter 5 of publication 560 is for self-employed. And it says, as discussed in chapters 2 and 4, if you're self-employed, you must use a rate table or a rate worksheet and deduction worksheet to figure the deduction for contributions you made for yourself to a SEP IRA or qualified plan. Now, a simple IRA is a qualified plan, but it says explicitly in chapters 2 and 4. Well, chapters 2 is for the SEP IRA and chapters 4 is for all other qualified plans. So it really neglects to say simple IRA anywhere in this chapter 5, except where you would find the same exact information as the SEP or a qualified plan. So right now we're at a difference. Now the difference is small. So if we took the worksheet and we applied that multiplier and we went to line 4 on Schedule SE, our answer for $100,000 in net profit would be that $92,350. Now, if you look at the worksheet, which says you need to do this if you're self-employed, it's a completely different calculation. That would take your net profit of $100,000 and subtract 1/2 of your self-employment, or that $7,065. That would give us $92,935. A little different, but they're not the same number. Now, the reason this is so confusing is because your net profit is your gross income minus your deductions for the business. Well, the employer contributions are a deduction of the business. So if you dig a little further into the IRS's website, you're going to find a page called Self-Employed Individuals Calculating Your Own Retirement Plan Contributions and Deductions. Well, it gives this great explanation that I'm going to read to you. And it says, you use your plan compensation to calculate the amount of your own contributions and deductions. But note that your plan compensation and the amount of your own plan contributions or deductions depends on each other. To compute one, you need the other. This is a circular calculation. One way to do this is to use a reduced plan contribution rate. So that, if we look at the worksheet on chapter 5 of publication 560, it totally makes sense. Because you have one that needs to be reduced, but as you make that contribution. So there is a formula for it that uses a reduced rate, and it's on that worksheet. So the confusion is really which one comes first, the chicken or the egg? That's really what we're looking at here. You need your net profit in order to figure out what your match is, but to figure out your match, you need to know your net profit. So we have to figure out how to do that. Well, this is a great explanation. You need to use a reduced rate. However, this worksheet doesn't apply to simple IRAs at all. So the real question is, did the rate worksheet specifically leave out simple IRAs, or are they really just referring to the qualified plans and including the simple IRAs? It really is kind of confusing, and most of the internet kind of agrees. Now, when I was going through all of this, I was wondering, why is this so confusing? They're trying to use publication 560 to answer our questions, but it's just really raising more questions than it does answers. And even if you look a little bit closer on the IRS's website, they have an entire page dedicated to simple IRAs for the sole proprietor. But they use the same exact formula that they did in publication 560. There is no difference. The only thing they did was leave out the last names that they use in publication 560. Like, they couldn't just come out with another example to help clarify what our questions are. I mean, come on. I did want more clarification on the exact formula. While they were very close, I wanted to know exactly which way was the correct method. So when I called the IRS, which I did about 5 times, I got different responses. Some of the agents said to use one formula, while some of the agents said to use the other. But all the agents said across the board that they don't provide specific tax or legal advice. Go figure. So they just referred to the publication 560 every single time I called. So here's how we can tie it all together. If we go back to page 4 of publication 560 for 2018, what we're going to find is, for self-employed individuals, compensation means the earned income. And you can see that it's a simple IRA plan and it has all the other plans listed there. But if we continue to read, we can see that simple plans, a special definition of compensation applies for simple plans. So right now, compensation is the same thing as earned income. From those two pieces, we put them together. But the simple earned income or compensation is different because it just said it. And if we jump to that chapter 3 again, we could see that your compensation is your net earnings from self-employment. So really what we have here is your net earnings is the same as your earned income, is the same as your compensation when it comes to simple IRAs, and your compensation is different than other plans. Now, why is this important? Because there are calculators out there that are wrong, that are lumping together SEPs and simples as the same calculation, where they're saying it's earned income and here's the definition of earned income. But the definitions are different for different plans. So the math on the simple IRA for the sole proprietor is taking your net profit, multiplying it by 0.9235, and then multiplying that by your contribution rate. And it's capped at 3%. So that's the matching side. And then you can put up the $13,000 for 2019 and $13,500 for 2020. So if you're wondering, what's the max that you can earn to completely max out the simple IRA? That is taking the $13,000 and dividing it by 3%. That means if you had $433,333 in total compensation, so that's after your net profit multiplied by 0.9235, then you can put in 3% and that'd be another 13,000. That equals 26,000, the max that you can put in. But of course, there's other plans that you should consider if your income is that high and you want to save a bunch of money. But if you have lower income and you want to maximize your contribution, this is a great option compared to the SEP IRA, which is capped at 20% if you're a sole proprietor, or right about 20%. So you want to make sure that you understand the math behind these contributions to maximize your retirement savings. If you've enjoyed this video, be sure to subscribe and leave your comments down at the bottom.